Assalamualaikum warahmatullahi wabarakatuh, everyone. We are here back to look at some aspect of Islamic bank risk management, and one of the topic covered in the class is the credit risk management process, and we have been emphasizing the fact that for bank to make a good loan or make a good murabaha, they must observe the risk management process, that is, for every loan or murabaha to be issued out to the prospective customer, the bank must be able to identify what are the risks associated with this exposure. So the bank must identify the risk, the bank must measure the risk, and the bank must be able to mitigate the risk. So the risk that we are looking at is, of course, the three basic risks or inherent risk in banking, and that is credit risk, market risk, and operational risk. So our main concern today is to look at the credit risk management process. So we will first start with credit risk identification. In this presentation, I will be using the term loan and murabaha interchangeably because the idea is to provide you with a general exposure to credit risk management, where we are in the stage of financing. So in murabaha financing, we are dealing with the financing stage of the murabaha, where payment is made on installment basis. So we are just looking at similar financial arrangement in the loan, in the banking loan system, where a debt is created from the loan, whereas in Islamic banking, a debt is created from the tawaru or from the murabaha, and that debt need to be serviced by the borrower or by the customer. So the nature of this credit risk management is very similar to conventional banking. So sometimes I'm using the term loan for murabaha because the murabaha financing that we are doing today in the Islamic bank are very much similar to the loan financing. So the credit risk management process is very similar because we are looking at the possible default that may occur when a loan or murabaha is extended to the customer. And so that is why before making the loan or before extending the murabaha, the bank will have to do or will have to observe the risk management process or the credit risk management process, and that of course is to identify the credit risk, to measure the credit risk, and to mitigate the credit risk. And here you will see that identifying credit risk in banking, whether or not we are dealing with Islamic or conventional, it involves assessing the likelihood that a borrower or the customer will default in their loan or murabaha or financing obligation. Right, so that is the danger in making loan or in the extension of murabaha. The danger is that there is a likelihood the customer may not be able to pay the debt. So in order to identify the credit risk, this is done using quantitative models, credit scoring, and financial ratios to evaluate the credit worthiness of the customer. So essentially, the bank will have to, the bank would require the document submission by from the customer, so that the bank is able to accumulate the required data for them to quantify the respective parameter for the credit assessment. So essentially it is about the evaluation of the credit worthiness of the customer. So we can see here that there are two types of financial ratios that will be computed by the bank, and this will be the debt to income ratio. So the DTI ratio is a measure of an individual's ability to manage the monthly payment and to repay the debt. So the higher the DTI ratio indicates higher credit risk. So you will be computing the DTI ratio, and any ratio that is on the high side indicate a risky borrower. The second ratio that we will be looking at is the loan or financing to value ratio, and it is a ratio that measure the loan amount relative to the value of the collateral. So in case if you look at a secured loan, it's a loan that is backed by collateral. It can be a property, it can be shares, or any valuable asset that the bank accept, to ensure that the loan that we take from the bank is free from the danger of loss from default. So a higher LTV ratio suggests a higher credit risk. So we would like to go into this as we move on. So the debt to income ratio, the DTI, is a financial metric used by lenders or used by banks to assess a borrower's ability to manage monthly payment and to repay debt. It compares the borrower monthly debt payment to their gross monthly income. So in the sense that the assessment of the credit standing of the customer will be based on how much monthly debt payment the customer has currently plus their monthly salary. So a lower DTI ratio generally indicate that the borrower has a manageable level of debt relative to their income, which lower the risk for the bank. Okay, so we can see here that for the debt to income ratio, the formula is basically the monthly debt obligation divided by the gross monthly income multiplied by 100. All right. So as we see here, as given by this formulation, and we can see that the total monthly debt payment will consist of the monthly debt payment, which is the sum of the borrower's monthly obligation, from their mortgage obligation, car loan, student loan, credit card payment. So this need to be summed up to get the total debt payment for the month, and the denominator, which is the gross monthly income, is the borrower's income before taxes and other deduction. So if we take an example for DTI ratio, the detail of the customer, let's say his monthly income or her monthly income is $5,000 or ringgit, and then the monthly debt consists of mortgage, car loan, student loan, and credit card payment. And for mortgage, it is 1,200 ringgit, and car loan $300, and then student loan $150, and credit card payment 100. So what we will do here is to calculate the total monthly debt payment, and that will be equal to 1,002 from mortgage, 300 plus 150 plus 100, and that will be equal to $1,750. So that is the total monthly debt obligation of the customer. And then we have the $5,000, which is his salary income. So the DTI ratio is equal to the 1,750 divided by 5,000 times 100. So we get a DTI ratio of 35%. So how do we actually use this number that we derive from the ratio, DTI ratio of 35%, which means that 35% of their gross monthly income is going towards servicing debt obligation, right? So that is the amount of money, meaning that for every $1 of salary, the person uses 35 cents to settle his monthly debt obligation. So what does it mean to the bank given the DTI ratio of 35%? So let us see here that DTI ratio below 36%, this is generally considered a manageable level of debt, indicating the borrower is more likely to be able to meet his or her additional obligation that is coming from the new loan without defaulting. So the borrower that has a DTI ratio below 35% is considered a lower risk. Yeah. Then we have a DTI ratio between 36% and 43%. This is often seen as a moderate risk range. While the borrower can handle that, any further increase above 43 or arriving at 43 could push the customer into financial strain. So bank may be cautious and may not approve the loan or the murabaha, and may offer a loan with a stricter term, maybe a loan with higher interest rate or higher profit rate. And then lastly, any DTI ratio above 43%. So this is typically viewed as a high-risk situation. A higher DTI suggests that the borrower is committing a significant amount of his or her income to debt payment, which could leave little room for emergency or additional debt obligation. So meaning that for every $1 of salary, the customer is using 43 cents to settle his existing debts. So this may not be good for the bank. So banks may be reluctant to approve the loan or the murabaha for the individual in this category unless they have a strong compensating factor, or for example, larger saving or higher credit score, that can help relieve the customer from being charged a higher interest rate if the bank feels that the customer may be willing to accept the loan at a higher interest rate. So we need to see that this is how we can come up with a DTI ratio given the monthly debt consisting of the mortgage debt, car loan, student loan, credit card payment, and we will obtain the DTI ratio by dividing the total debt payment over the salary. That will give us the DTI ratio of 35%, which is the case in this example. So this is one of the way and means to calculate the DTI ratio to evidence the credit standing of the customer. We can also see another parameter to measure or to assess the credit standing of the customer, and that will be through the loan to value ratio or financing to value ratio. And we can see that the formula is loan or murabaha amount divided by the market value of the collateral. So if the property value is 100,000 and the requested loan is 75,000, so the LTV ratio will be 75 divided by 100,000 times 100, so that will be 75%. And we can see that in the assessment of the loan or financing, any LTV which is lower than 75% is considered to be standard risk that is acceptable by most banks. LTV 75 to 90% higher risk, and any LTV that is greater than 90% is a very high risk. Usually the bank will reject that kind of customer. So the decision by the bank is that if the LTV is higher than 75, maybe the bank will approve the loan but may charge higher interest rate or higher profit rate. Okay guys, so this is just a very brief introduction to the credit assessment in the credit risk identification process required by the bank in the loan or in the extension of murabaha. So I see you again inshallah. Assalamualaikum warahmatullahi wabarakatuh.